Pestrichelli.
Hi, everybody.
Welcome back, Jay. So this is in person now.
I know we're live.
Yeah,
in
we're
person.
live.
Amazing.
So, absolutely. So we were just talking to Mike, and we realized that like the concept of NAV erosion, like there's really no such thing, as he was explaining. So we're going to ask it a different way.
Not with YieldMax, at least, right? Not with these things. Yeah,
right.
It's different.
So the terminology, like Mike said, should be like beta compounding or something was how he described it.
Mike is so smart. Like,
yeah, he is,
I love like Venuto is great. He has a lot of knowledge. Like I think it's one of those things. Like when you think about, and maybe I'm going to give you a different explanation than Mike did. But when I think about, you good? You got to sit.
I was trying to, just turn it.
You want to get both of us? You want me to stand next to you?
I think I got it right here, like this. Let's see. There we go. Yeah.
How's that?
Move in, yeah.
Move in. Grab that chair.
Coach is unprepared as usual.
My
All right.
favorite unprepared coach. So when I think about it, what's in the price change of of one of the LevMax builds? It's the movement of the stock and the impact of the option strategy.
Yep.
Right. Stock goes up, things are going to go up. Right.
Right.
And then if the option strategy makes money, the NAV will go up a little more, and then we distribute that down. If the option strategy loses money, there's an offset. If the market goes down and the option strategy makes money, we're still going to distribute that out. So if you think about the two components that go into the NAV, it's the option piece and the long stock exposure. That's it. You just know you're always going to get the option exposure distributed out, right?
Yep.
So that impact has this, a declining impact on the NAV itself. I'll call it a decline. It's fine to call it a NAV decline.
Right, because it does drop. The funds do drop.
The NAV will drop, yes. Unless the underlying goes up. You look at Palantir, you look at Hood, you look at Carvana, you look at MicroStrategy, right? You can have appreciation. But if you look at, and I'm going to use some round numbers, right? If you look at Misty that went live at 20, it's trading at 22 today, I think. It is distributed $39. Like, do you really feel like you had decay? No.
Right, and it's at its same level that it was like before, when it launched.
So it doesn't always have to go down. It doesn't always have to go down, right? It's not built in like a triple leverage fund or a futures-based fund that has to deal with contango, and let's not explain what that is. But so the concept of NAV decay really isn't appropriate. And actually, it's funny. Like, there's so much chatter about it. I feel like we need to get ahead of it and just re-educate people.
Definitely.
It's just the nature of a cover call strategy.
Right.
Which is why, by the way, if you reinvest some or all of the dividends, I know it's not the most popular thing for me to say, your portfolio allocation will be bigger and you have more shares. So
if you reinvest.
Do a DRIP, right? Dividend reinvestment program.
Right.
At your broker. It's one of those things. You know, if you went from 1,000 shares to 2,000 shares and the price of the ETF went from 20 to 10, you're still at the same value, right? So, I think there's this nice mix that everybody will figure out what their reinvestment rate is. Look, if it's zero, it's zero. Just realize you're divesting to cash.
Yeah.
If it's all of it, you realize you're double downing every single week or every single month, whatever the time frame is. So if you're like, hey, I'm here for the yield, guys, stop telling me to give you all my money back. Fine, that's one approach. But have some going back in. They're built to be reinvested, right? I mean, that's the whole thing.
Well, and like you've said, there's a YieldMax fund for everyone. So people that want a more stable dividend with lower dividend, more stable, if we will NAV, then there's that.
Look at AMZ, right?
Yeah.
Look at Amazon. Look at Netflix, right? I mean, there's a long history there from time to time, they've had one-day moves that have been interesting over the last year and a half, 2 years, 3 years. But look at those as an example of stability in the NAV with consistent distributions from income. That could be somebody's flavor.
True.
Yeah.
Now, Mike introduced a very interesting topic. So you guys have something called LevPro on the way. LevMax. I keep getting it wrong.
Yeah.
You know why? Because I'm used to Pro shares with the 3X.
Oh.
And this sounds like a game changer though. Because
it might be
3X with limited downside. That sounds. You want to talk to that? That sounds.
Yeah.
Very
So let me explain it.
Yeah.
It is 1-for-1 downside. It's actually no limited downside.
Okay.
But then it is 3X up with a cap.
Yeah. So 1X down, not 3X down.
1X down only.
That sounds amazing.
That's great. So it's long stock risk.
Right.
That's 1X down.
Yeah.
And then the upside is 3X, but to a level. So let's just use a very broad example. We are long NVIDIA. And then we buy 2 calls at the money and sell 3 calls out of the money, right?
Yeah.
Okay, that's a little nerdy for me to say that. So basically what that'll give you is up until that short strike, you should make 3 times the appreciation of NVIDIA. So let's say that strike is 3% out of the money for next month. If NVIDIA is up 3%, that fund should be up 9.
Yep.
If NVIDIA is up 2%, that fund should be up 6. If NVIDIA is up 10%, still only be up 9 because you have a cap.
Oh, I see. So it's
Yes.
capped at that. I
It's
see.
capped.
Yeah.
It's not 3x unlimited up. It's 3x to a level. And the argument is that's a level the market is kind of defined as, well, maybe that's what you're getting at. Who knows?
But that's like the price you pay for the limited downside too.
It's the price you pay for the leverage is giving up some of the upside.
Yeah.
The limited downside is just because we're going to use the long stock as collateral, like the long exposure. So
Right.
we may use synthetics again, like YieldMax. We may use swaps, which we've never had a conversation about that.
We should, because that was one of the ways. So a lot of people thought, not to change the subject, but a lot of people thought that what was in your prospectus for a handful of funds
Misty and NVIDIA.
about NAV erosion, dare I say, like mitigating NAV erosion, which is not being implemented yet. But that included swaps and owning more of the underlying, right?
Yep.
And selling further out of the money.
I don't know if we put that in there, but here's what
Yeah.
you're right. We made some changes. Those changes will have zero impact on the performance of the fund, zero impact on the NAV. Actually, I would say in some cases there's one example in there which was using a deep in the money call to get your long exposure.
Right.
That might have a little 50, 100 basis point improvement on performance, but you fail the ETF test, right? So there's this concentration test when it comes to ETFs. You can have more than 25% market exposure in any name. This is why YieldMax works. The combo keeps you under full, because people say, why don't you just own the stock?
Yeah.
Can't own 100% of MicroStrategy in MSTY, you won't pass the diversification test.
Right.
So we use options to do it. But those are all tactics that were added in case we had capacity constraints from OCC contract level. Those are all those. Look, I know it's like, wait, can't wait for them to do the new strategies. They're the same, no change. It won't impact any of the returns.
Like you said, it won't have any impact on NAV at all.
Nothing on NAV, nothing on returns, nothing on distribution rates, no change at all. Just different vehicles, different ways for us to execute the strategy.
Right. Yeah.
If we needed it. If we needed it.
Now, can you explain to people that may not know, like, just in basic terms, like a synthetic and a swap to the audience members that might not know?
Okay, a swap, here's the way a swap works.
Yeah.
It's just a contract with you and a bank, and every swap represents one share, right? So it's just like owning stock, except in a bank note. You'd be like, well, why would you do such a thing? Well, I can hold bank notes and treasuries and bonds. They don't count towards that concentration requirement. So you look at leverage funds, right? It's like everybody here, most people have probably bought on margin, right? Hey, I have $100, but you bought $200 worth of stock. That's how you get the 2 times leverage in a swap product, right? This is not YieldMax, by the way, no leverage in YieldMax. But other swaps, this is the use case of why you'd use a swap. It's just an agreement with the bank.
Yeah.
And there's an expiration. And at some point they could call the note, and there's a margin requirement for it, but there's no margin balance. So you can use collateral to pay for it.
Yep.
That's a swap. A combo, you've heard me talk about the combos all the time. Long call, short put, with the treasury, 100% replicate long stock. So you get tick for tick move on that build, the 3 pieces. You need the treasury piece for collateral and the yield.
Yep.
Makes it feel like you're long stock. That's it. These are just all different ways
It's
of getting stock.
mimicking the stock.
It's
That's
all
why they
mimicking
use that
stock.
term, synthetic.
That's right,
Yeah,
synthetic,
right.
like it's replication. What I
Right.
tell you, when you look at a fund like ULTI or LFGY or Chippy, when you look at those funds, those we don't have the concentration requirements or issues because there's so many different holdings in those. Instead, with those, we have long stock.
Yeah.
It's just that it is easier to own long stock. Let's face it.
Absolutely.
I never have to sell it. There's no expiration. There's no tax realization.
But you know, most of this audience, like, they invest in these funds because they want the quick gain. Like, owning stocks, like, boring now, especially to the newer generations. You know, people want the quick, like, the high. They want to get rich quick.
right?
You know?
Like you just got to pick the right stock.
That's
right?
why I
Picking
do
the right
options.
stock.
I do options videos. They don't get nearly the views that like a dividend video does. Yeah.
I love that world right now.
Yeah.
This wasn't always the case.
Right.
Yeah.
Yeah.
Look, I think there's all of these different tactics that we utilize here. It just helps go like, look, the level of. It's funny. I was doing an education curriculum for somebody.
Oh, yeah.
And it was just explaining all the different tactics we use in YieldMax, and I was like, wow, we use like 14 different option tactics to execute these strategies, right? And it just, there's so much flexibility in a lot of the builds. There's so many different ways to do the same thing. we're always looking for the most efficient.
Speaking of education and curriculum, I'm going to plug your book too. I recommend that anyone should read your book for sure.
The Buy and Hedge book.
Yeah,
Buy and Hedge. The
Absolutely.
5 Iron Rules for Investing Over the Long Term. So look, I wrote that book in 2010 with my former partner Wayne Ferbert. He and I wrote that book. I would tell you, there's a lot of good market philosophy in there that still applies today. There's a lot of education on how to do it yourself, how to build different strategies. There's a whole chapter about covered calls. There's chapters about collars. The only thing I'd say is a little dated is the market structure has changed, right? There were no zero DTE options. Leaps were less liquid back then, and we were like, stay away from leap. Now leaps are amazing. You could put tons of money farther out.
Back then, stay away from leaps was the conventional.
Yeah, it was just they were really wide. And look, they are still wide markets, right? It's going to be hard to get a good fill, but now there's so much more liquidity in the leaps. It's better. So, there have been advancements over the last 15 years
There's
in the
more
options
liquidity.
space.
Why?
More people are using them as stock replacement,
sense,
right?
yeah.
Look, I'm going to quote not a competitor of ours, but a different ETF company, Innovator, right? Billions and billions of dollars in buffers. Didn't launch till 2016, right? The market is evolving. So I think the first 12 chapters about why managing risk is important, why volatility is important to manage, why you need to take emotion out of investing. All of those lessons still ring true today.
Yep.
Great. And then all of the information about how the market structure of option builds works today. So if that's kind of stuff you're interested in, great. The book's focus more on hedging, not income. I do think we probably need an income book.
Yeah, we need a sequel, right?
All right.
The audience
I'm gonna
agrees.
think about it.
Yeah. We got a couple of questions here from the live. Is there any tickers yet for the LevMax funds?
Everything has been filed. I don't know the tickers if they've been decided yet or not. We'd have to look at the filing. Yeah, the prospectus has been filed. I still think we've got 60 days to go before those can be active, so there's time.
Okay.
There might be tickers in there. I don't recall what they are.
Okay. We can rest assured, though, that YieldMax will come up with very creative ticker names like you have for NVIDIA with the inverse fund and so on. Dips and chips.
Yeah. Look, by the way, LevMax is not YieldMax. They are different. It is more of a structured product for a 1 month period. You got that 3 up, 1 down, and then we do it again every single month. I don't know what the yield is going to be on these. It's not the focus of yield. The focus on LevMax is capture that short-term leverage.
Mike mentioned Innovator ETFs also. These are going to be similar in structure to some of those.
Yeah, but they are longer in term, and I think we're doing it. Look, obviously we're going to do something a little more innovative than exists today. We're not going to replicate anything. There's lots of buffered and accelerator products that are out there. We think that this, again, is going to be a unique offering. But again, not YieldMax, LevMax. Different.
And then ULTI, our favorite fund. The question we always go back to. Why ULTI no go up, right?
Hey, so ULTI go up, bro.
Say that again.
ULTI go up, yes.
So I look at ULTI, there's people that absolutely, they say it's one of the best funds out there, and you're paying a consistent dividend.
It's been fairly consistent in that 80-85 range annualized basis. Yep. Weekly now, which made it harder. Going to weekly was harder because not to come up with 1.5%, 2% cash every week. So we're constantly kind of selling and closing positions. We get close on this.
There we go.
Yeah. So look, ULTI go up.
ULTI go up.
ULTI go up. Look, I think this is. You've seen the path of ULTI. Mm-hmm. You saw the changes we made. You saw the protection aspect that was added, but we didn't change the names. We didn't change the level of volatility we were going for.
Right.
We just changed the option structure. So I think there's been a lot of positive momentum on ULTI lately because of performance. Mm-hmm. Hats off to the guys that are doing those, right? The team is doing a wonderful job on ULTI. I think we'll continue to see more growth there. But let's face it, ultimately, it's about total return. Right. And we've got some pretty positive total returns right now when it comes to ULTI.
Right. Yeah. Awesome. Well, thanks for your time, Jay. We got to squeeze this in there.
It's always good seeing you, Coach. I'm glad we can do the bell ringing again together.
Absolutely. This is phenomenal.
Yeah.
Well, I'll fist bump you.
You got it, man.
Jay. Awesome. Thanks, everybody, for tuning in. Like, comment, and subscribe, and join Discord. We'll see you all at the bell ringing. All right. Bye. Awesome.